Welcome to the Investor's Journey, a guide to navigating India's mutual fund landscape. This video will help the aspiring distributor master the path from financial goals to wealth creation. We will understand what mutual funds enable for the investor. Every journey needs a destination, emphasizing the primacy of financial goals. As a guide, your role is to help investors convert abstract objectives, like a good education, into concrete financial goals with specific timelines and amounts. Examples include a property purchase in 2 years or wealth accumulation for retirement in 15 years. The unseen headwind in this journey is inflation, which silently erodes purchasing power. An investment must first beat inflation to generate a, quote, real rate of return. For example, with an 8% annual inflation, goods worth 10,000 rupees today will cost 46,610 rupees in 20 years. The first challenge is to outpace inflation. Mutual funds are the ideal vehicle for this journey. They are professionally managed trusts that mobilize money for a diversified portfolio. Key advantages include professional management, affordable portfolio diversification, economies of scale, liquidity, transparency, and regulatory comfort under SEBI. Understanding the structure of a mutual fund is essential. It is a 3-part structure involving the sponsor who establishes the fund, the trustees who oversee the fund's assets, and the Asset Management Company, or AMC, which handles day-to-day operations and investment management. The Securities and Exchange Board of India, or SEBI, provides the guardrails for the journey. SEBI's core mandate is to protect investors' interests. This is achieved through strict disclosure norms, risk management systems, governance norms, and the centralized investor grievance redressal system. SEBI standardizes schemes into 5 broad categories. These are like different vehicles for specific purposes: equity schemes for long-term wealth creation, debt schemes for income and capital preservation, hybrid schemes for a blend of growth and stability, solution-oriented schemes for life goals with a lock-in, and other schemes. To read the map, we must understand a scheme's risk profile using the SEBI-mandated risk-o-meter. This meter shows 6 levels of risk, from low to very high risk. As a distributor, the risk-o-meter is the first step in determining suitability, matching the fund's risk to the investor's appetite. The guide's mandate is to help investors navigate complexities, select suitable schemes, and execute transactions. Becoming a distributor involves certification, KYC, registration with AMFI, and empanelment with AMCs. Revenue is primarily earned through trail commission. Plotting the course involves onboarding the investor, which requires mandatory KYC and a permanent account number, or PAN. Systematic transactions, such as the Systematic Investment Plan, or SIP, Systematic Withdrawal Plan, or SWP, and Systematic Transfer Plan, or STP, are powerful tools for structuring the journey. The art of navigation involves principles of wise scheme selection. This includes strategic asset allocation and the core and satellite portfolio framework. A key challenge is avoiding behavioral biases like recency bias, confirmation bias, overconfidence, and loss aversion. Measuring progress requires evaluating a fund's performance against an appropriate benchmark. Total Return Index, or TRI, provides a more accurate comparison than the Price Return Index, or PRI. Key performance metrics include Compound Annual Growth Rate, or CAGR, Sharpe Ratio, and Alpha. Reaching the destination involves understanding taxation on returns. Tax is paid by the investor at redemption or when receiving dividends. Capital gains vary based on the scheme type and holding period. Equity-linked savings schemes, or ELSS, offer tax deductions under Section 80C. The distributor's creed is an ethical compass. Your success is built on trust, earned by prioritizing the investor's interests. The guiding principles include acting with integrity, ensuring suitability, exercising due diligence, maintaining confidentiality, and providing full disclosure.